15 countries just joined the BRICS payment system pilot. Together, they represent 40% of global GDP and 50% of the world's population. This is not a symbolic gesture. This is not a talking point at a summit. This is the architecture for a post-dollar monetary system going live, and it's happening faster than any Western analyst predicted. If you want to understand the currency war before the casualties pile up, subscribe now and position accordingly. Let's be precise about what just happened. The BRICS nations, Brazil, Russia, India, China, South Africa, announced expansion of their cross-border payment system pilot to include 15 additional countries. The new participants include Saudi Arabia, UAE, Egypt, Argentina, Ethiopia, Iran, Indonesia, Kazakhstan, Thailand, Vietnam, Nigeria, Algeria, Bangladesh, Cuba, and Belarus. This system allows member nations to settle trade directly in their own currencies, bypassing the dollar entirely. No SWIFT system, no correspondent banks in New York, no dollar conversion fees, no exposure to U.S. sanctions, no dependence on Western financial infrastructure. For decades, this was theoretical, a talking point at BRICS summits, a threat that Western policymakers dismissed as implausible because there is no alternative to the dollar. That assumption is now obsolete. The infrastructure exists, the system is operational, the technology works, and the number of participants is accelerating. Think about what these countries represent. Saudi Arabia is the world's largest oil exporter. If they settle oil sales in yuan, rials, or a BRICS currency unit instead of dollars, the petrodollar system, the foundation of dollar dominance since 1974, collapses. UAE is a major financial hub and gold trading center. If they facilitate non-dollar settlements, billions in daily trade flows bypass the dollar. Indonesia is the fourth most populous country on earth, 280 million people, a massive consumer market. If they trade with China in yuan and rupiah, that's enormous volume outside the dollar system. Egypt controls the Suez Canal, one of the most critical shipping choke points in the world. If canal fees can be paid in non-dollar currencies, that's another pillar of dollar utility gone. This is not a coalition of small, irrelevant economies. This is the majority of global commodity production, manufacturing capacity, population, and future economic growth opting out of dollar dominance. And once that optionality exists, once countries can trade, settle, and store value outside the dollar system, the incentive to hold massive dollar reserves collapses. Here's what most mainstream coverage completely misses. The dollar's role as global reserve currency was never about military power alone or economic size alone. It was about network effects and settlement convenience. If you're Thailand and you want to buy oil from Saudi Arabia, historically, you both converted to dollars because dollars were universally liquid. Everyone accepted them. The infrastructure existed, SWIFT, correspondent banking, etc. The alternatives were worse, but that system had costs that nobody talked about. You had to hold large dollar reserves, earning minimal interest just to participate in global trade. You were exposed to Federal Reserve policy decisions made for the benefit of the U.S. economy, not yours. You could be sanctioned and frozen out of SWIFT if you crossed the United States politically, even if you did nothing illegal under your own laws. Your reserves could be confiscated, like Russia's $300 billion, overnight with no recourse. For decades, those costs were acceptable because there was no alternative. The dollar system was the only game in town. BRICS just created the alternative. Now Thailand can settle with Saudi Arabia in baht and rials through a BRICS clearing mechanism. China can buy Brazilian soybeans in yuan and reals. Russia can sell oil to India in rubles and rupees. Indonesia can trade with Vietnam in rupiah and dong. The dollar isn't needed. And every trade settled outside the dollar system is one less reason to hold dollars as reserves, one less reason to accept dollar dominance, one less reason to tolerate U.S. sanctions policy, one less reason to care what the Federal Reserve does. Now compound this with what's happening simultaneously in energy markets, the single most important commodity sector for reserve currency status. Russia is already settling most trade with China, India, and friendly nations in non-dollar currencies. After Western sanctions cut them off from SWIFT, they built alternative payment rails, and they work. Russia-China trade exceeded $200 billion in 2024, with over 90% settled in yuan and rubles. $0 involved. Russia-India trade is conducted in rubles and rupees. India buys discounted Russian oil, pays in rupees. Russia uses those rupees to buy Indian goods. A closed loop. No dollars needed. Saudi Arabia, the cornerstone of the petrodollar system since the 1974 agreement with the US, is now openly negotiating yuan-denominated oil sales with China. Let me repeat that because it's critically important. Saudi Arabia, which has denominated oil sales exclusively in dollars for 50 years, is considering accepting yuan. That's not speculation. That's confirmed by multiple sources, including the Saudi Finance Ministry and the People's Bank of China. If that happens, if even 20% of Saudi oil exports shift to yuan settlement, the petrodollar system cracks. The UAE is building gold-backed trade settlement systems in Dubai, allowing countries to settle in gold-referenced digital currencies rather than dollars. Iran has been completely cut off from dollars for years due to sanctions. They developed alternative payment networks with Turkey, Russia, China, and others. Those networks are now expanding to include other sanctioned or sanction-threatened countries. Every one of these shifts was dismissed by Western analysts as economically irrational or doomed to fail. Nobody will accept yuan because China's capital controls make it unusable. Russia's payment systems are too small to matter. Gold-backed digital currencies are a fantasy. But they didn't fail. They adapted. They grew. And now they're expanding into a coordinated system that presents a genuine alternative to dollar hegemony, because the rest of the world learned a critical lesson from the sanctions on Russia. If the United States can freeze $300 billion in Russian central bank reserves overnight, reserves that were supposed to be held in safe Western banks and securities, it can freeze anyone's reserves. Once that precedent is set, holding dollars becomes a geopolitical risk, not just a currency choice, and the rational response is diversification. Let's talk about what happened to the British pound because the parallel to today is exact. In 1914, the pound was the undisputed global reserve currency. The British Empire controlled a quarter of the world's land and population. London was the financial capital of the world. Sterling was the currency of international trade. If you wanted to buy rubber from Malaysia, or cotton from Egypt, or wheat from Argentina, you settled in pounds. The system seemed permanent, inevitable, too big to fail. By 1944, the pound was finished as the dominant reserve currency. Not because Britain lost a war, they won World War II, but because they bankrupted themselves winning it. The war required borrowing on a scale that destroyed the pound's credibility. Debt to GDP exceeded 250%. Inflation ran rampant. The empire was collapsing. Britain needed American loans just to stay afloat. The United States emerged as the creditor, the industrial powerhouse, the military hegemon. The Bretton Woods Agreement in 1944 formalized the transition. The dollar became the new global reserve, backed by gold. The pound became a secondary currency. The transition didn't happen overnight. The pound declined over decades. But the structural shift, the moment when the new system replaced the old, happened in a narrow window between 1944 and 1971. We are in that window now for the dollar. The BRICS payment system is the new Bretton Woods. It's not a single conference with a signed treaty and photo ops. It's a distributed, multinodal infrastructure being built in real time by countries that represent the majority of global population and future growth. And just like the pound, the dollar will not collapse overnight in a spectacular crisis that everyone sees coming. It will decline gradually through 1,000 small decisions, a trade settled in yuan here, a bond issued in euros there, a reserve allocation shifted to gold. Then suddenly, when some critical threshold is crossed, the transition becomes visible to everyone at once. By then, the BRICS payment rails will be handling trillions in annual trade volume. By then, central banks will have already diversified reserves. By then, the dollar will have already lost the network effects that made it dominant. And the people asking, what happened, will be the ones who assumed the system was permanent. Here's the irreversible dynamic now in motion. Once a critical mass of global trade can settle without dollars, the demand for dollar reserves falls structurally and permanently. When demand for dollar reserves falls, the United States loses the exorbitant privilege, the ability to run unlimited trade deficits without consequence because foreigners need dollars for trade and willingly hold U.S. debt. When the U.S. loses that privilege, it can't fund its military, its entitlements, its debt service, its deficits without either. Massive tax increases, politically impossible. Massive spending cuts, politically impossible. Money printing, debt monetization, destroys the currency. Default destroys credibility. There is no fifth option. The political system will avoid options 1 and 2 until the absolute last moment because they require political courage and inflicting pain on voters, which means the end game is either option 3, inflation currency debasement, or option 4, default restructuring. Both outcomes destroy the dollar's value in real terms. Both outcomes validate the BRICS strategy of building alternatives. And both outcomes accelerate the shift away from dollar dominance. It's a self-reinforcing cycle. The BRICS payment system provides the infrastructure that allows that cycle to accelerate without triggering immediate crisis. Countries can slowly, quietly rotate reserves from dollars to gold, yuan, euros, or other assets without making dramatic announcements that crash markets or provoke U.S. retaliation. But the end result is the same. Dollar dominance ends, not because of military defeat, not because of sudden economic collapse, because the rest of the world built a system that works without it and chose to use that system. So what does this mean for you personally? If you live in the United States or hold primarily dollar-denominated assets, you are on the wrong side of this trade. Your savings are in a currency that is losing its structural demand while its supply continues expanding through deficits and money printing. That's not a recipe for stability. That's a recipe for devaluation. If you hold treasury bonds, even short-term ones, you are lending money to a government that will be forced to repay you in a currency worth significantly less than when you lent it. If you hold stocks, you are betting that corporate earnings can grow fast enough to offset currency debasement and that multiples won't compress when dollar liquidity dries up. Possible? Maybe. Guaranteed? Absolutely not. The individual investor does not have access to the information flows that BRICS central banks have. You are not in the Shanghai Cooperation Organization meetings. You are not receiving classified briefings on Saudi Arabia's oil settlement negotiations. You are not privy to the private discussions about yuan internationalization or gold-backed digital currency designs. But you do have the ability to read institutional behavior and position accordingly. And right now, institutions representing half the world's population are building a system designed explicitly to reduce dependence on your currency. That's not a conspiracy theory. That's documented official policy. The question is whether you act on that signal before the reason for the signal becomes obvious to everyone watching CNBC. Because once it's obvious, once Saudi Arabia announces yuan oil sales, once the BRICS currency unit launches, once dollar reserve holdings drop below 50% of global reserves, the repricing happens immediately. Gold spikes, the dollar falls, import prices explode, your purchasing power collapses, and by then, the opportunity to position is gone. Let's talk about what central banks are doing in response to BRICS expansion. We already covered record gold buying in video 1, but now layer in the geopolitical dimension. The central banks buying the most gold are the same countries joining or expanding the BRICS payment system. China, Russia, India, Turkey, UAE, Saudi Arabia, Kazakhstan, Egypt. This is not a coincidence. They are building a gold-backed trade settlement layer, not a full return to the gold standard. That's politically and economically impractical in a globalized economy, but a system where gold serves as a neutral reserve asset that no single nation controls, that can't be printed, that can't be weaponized through sanctions. Imagine this architecture, a digital yuan backed partially by gold reserves, making it more trusted internationally than pure fiat. A rupee-ruble trade corridor with gold settlement mechanisms for imbalances. A BRICS currency unit, possibly called the unit or R5, with gold convertibility that allows countries to settle trade without holding each other's currencies. These mechanisms are not hypothetical. They are being actively discussed and in some cases implemented in pilot programs. Russia has already proposed a gold-backed digital ruble for international settlement. China is expanding gold trading infrastructure in Shanghai to rival London and New York. The UAE has launched gold-backed stablecoins and digital settlement tokens. These are building blocks of a monetary system that doesn't require dollar reserves, and they represent a fundamental challenge to the dollar's role, because the dollar's advantage since 1971 was that it was backed by nothing except the full faith and credit of the United States government, which really meant backed by U.S. military power and economic size. That worked when the U.S. was the unquestioned hegemon. It doesn't work when the U.S. is a declining debtor nation, weaponizing its currency against geopolitical rivals while running unsustainable deficits. The BRICS alternative says, we'll use neutral assets like gold, bilateral currency swaps, and distributed clearing systems instead of trusting one country's printing press. And that alternative is gaining adoption faster than anyone predicted. Here's the moment of absolute clarity. You are living through the end of dollar hegemony, not the end of the dollar as a currency. The US will still have dollars. Americans will still use them domestically. But the end of the dollar as the unchallengeable global reserve, as the only currency that matters for international trade, commodities, and reserve holdings. And that distinction is everything. Because reserve currency status is what allowed the United States to print unlimited amounts, run unlimited deficits, import unlimited goods, and fund unlimited military spending without facing immediate inflation or currency crisis. The rest of the world had to hold dollars, so they absorbed the inflation through rising dollar reserves. Once that privilege is gone, the United States becomes a normal country with normal constraints, and normal countries with $36 trillion in debt, trillion-dollar annual deficits, and massive unfunded entitlement liabilities face sovereign debt crises. They face currency crises, they face inflation crises, they face political crises when the population realizes the government made promises it can't keep. The question is not whether this transition happens. It is happening right now. The question is how violent the adjustment is when it becomes undeniable to the average person. Will it be a slow, managed decline where the dollar loses 50% of its international role over 10 years? Or will it be a sudden loss of confidence triggered by a specific event? Saudi Arabia announcing yuan oil sales, a failed treasury auction, a BRICS gold-backed currency launch that causes capital flight and dollar collapse in months? The answer depends on how many people see it coming and position accordingly. The more people who understand the transition and protect themselves with hard assets, the more violent and sudden the repricing will be. Because once it becomes obvious, everyone will try to exit dollars simultaneously. Here's what you do. You reduce dollar exposure systematically and deliberately. You increase hard asset exposure across multiple categories. For physical precious metals, 10 to 15% of liquid net worth in gold and silver, not paper ETFs. Physical, allocated, or in your possession. For currency diversification, consider holding some wealth in Swiss francs, Singapore dollars, Norwegian kroner, currencies backed by fiscally responsible governments with current account surpluses. For international real assets, productive farmland in stable jurisdictions, energy infrastructure, water rights, timber, real assets that generate cash flow and hold value regardless of which currency dominates. You stop thinking like an American investor and start thinking like a global capital allocator. Because the world is moving past the dollar system, and the investors who cling to it out of patriotism or normalcy bias will be the ones left holding devalued paper when the transition accelerates. This is not about hating America or rooting for the dollar to fail. This is about recognizing that monetary systems are not permanent, that all reserve currencies eventually lose their status, and that the intelligent move is to position for the system that's coming rather than the system that's dying. The BRICS nations are building that new system right now. 15 countries just joined. More will follow, and the momentum is irreversible. 15 countries, 40% of global GDP, 50% of the world's population, opting out of the dollar system in real time. Saudi Arabia is negotiating yuan oil sales. The UAE is building gold settlement infrastructure. Russia and China are trading hundreds of billions without a single dollar. India is settling energy purchases in rupees. The alternative is no longer theoretical. It's operational. It's expanding. It's accelerating. And the only question is whether you'll adjust your portfolio before the transition becomes undeniable to everyone, or whether you'll be asking what happened after the dollar's reserve status is already gone. Because once it's gone, once the BRICS system is handling the majority of global trade, once central banks have diversified away from treasury holdings, the repricing is instant and irreversible. The people holding dollars will lose purchasing power. The people holding gold will preserve it. And the people who saw it coming will have already positioned accordingly. 15 countries just joined. The network effects are shifting. The system is changing. The only question is, are you changing with it?